What's up, guys? Today I'm going to be talking to you guys about support and resistance from a retail and an institutional standpoint. Okay, there's significant differences between retail resistance and support versus institutional resistance and support, right? So I'm going to start off with institutional support and resistance. Okay, now banks and other big funds, they always look at their 4-hour chart, daily chart, and their weekly chart, right? Obviously the best being at the weekly chart. So if I were to look at the weekly chart, right, I would say that these levels are support, support, and support, right? And I would say that these levels are resistance, resistance, and for now resistance, right? Okay, so what makes these points support and resistance, right? What makes these points so resistance and support? Now, retail theory makes all of you guys believe that support is where all the buyers begin buying and pushing the price up, and resistance is where all the sellers keep on selling, pushing the price down. Right now, that's retail theory, and that's not what happens. Okay, you can see all these Instagram and YouTube gurus speak about sellers are pushing price, buyers are pushing price up and down. That's not the case. Okay, that's not the case. It's actually institutions doing the buying, which is why at these reaction points it's followed by sharp moves, right? Sharp moves and sharp moves. Okay, see, sharp move here, and on the downside we have a sharp move here, right? And this is on the weekly chart. And in terms of pips, weekly chart has the most number of pips. The monthly does, but we use the weekly most of the time. So just one bar over here is 368 pips, right? So if you can catch the weekly range in your day-to-day trading, you make a lot of money. Okay, so this is basically how institutions look at their levels. They look at the weekly chart, they start off the analysis from the weekly chart, look at where price reacted the last, right? So you can see over here, price reacted here, price came down, price reacted over here, and you can expect it to react again over here, which it did not, right? Instead it came all the way down here, somewhere here, yeah, over here, where it last reacted the most, and reacted again there. But then when price came back up here, you can see a nice reaction which caused price to go down, forming another support over here, ultimately leading price to go up, which is the bull run that we are currently in. Okay, so apart from the weekly time frame, right, now keeping these levels in mind, let's go back to the daily time frame. Okay, so on the daily time frame you can see exactly how price or how institutions reacted at these levels. As you can see over here, nice reaction. Retailers call this double bottoms, which cause price to go up, up, up. And now these sharp moves are not caused by your retail buyers and sellers, it's caused by institutions. Don't let anyone tell you otherwise. Okay, they just don't know what they're talking about. Institutions cause these moves up, right? So in the long run, institutions do cause price to move, but in the short run, for example, these small blips on the screen, they are caused by retail traders, right? I'm not going to say that retail traders don't make the market move, right? They do, but only by a very small amount. Retail traders like you and me, right, we are nothing but a blimp to the banks and other financial institutions. So as you can see, these are your reactionary levels, and this is how institutions reacted to these levels, causing price to move up and down. Okay, so let's go back to the 4-hour chart, right? If you want, like if you feel like the weekly chart is not for you, right? Maybe you don't have enough patience waiting for price to come all the way back here to sell, because each bar, mind you, is a week, right? So if you cannot wait 1, 2, 3, 4, 5, 6, 7, 8 weeks before participating in this downward move, you can forget about these levels. Go to the daily chart, or let's just go to 4-hour chart, right? And you can mark your levels on the 4-hour chart. So now let's give an example, right? So an example would be this level over here where price reacted. Another one would be this level over here, here and here, right? And recently, yeah, no, let's not talk about recently. Okay, so now over here, this is your resistance. As you can see, price just touched it, went down, a nice big reaction, followed by our support over here, which we had a handsome reaction to, which caused price to go up, ultimately coming back down and going back up again. Okay, and let's say this reaction happened over here, right? So these are your support levels, these are your resistance levels, right? And what you should understand is, at resistance levels, right, we only sell. Okay, at resistance levels we sell. At support we buy. Okay, at support we buy. And the methods that I use to enter the market and take trades are actually based on all of ICT's concepts. And if you don't know who ICT is, his name is Michael J. Huddleston, also known as the Inner Circle Trader on YouTube. If you really want to know how to have these precise entries and how to actually be a proper trader, right? And if you want to know how the institutions actually work, this guy has 25 plus years experience as an institutional trader. Just watching his free YouTube content would help you grow a lot, right? And I am not allowed to teach his concepts because it's intellectually his and not mine. I can only show you how I use it, right? But for the scope of this video, I'm just going to be talking about support and resistance. Okay, entry techniques will be spoken about in another video. Okay, so moving on, we sell at resistance and we buy at support, right? And we are going to derive our support and resistance on 4-hour chart, daily chart, weekly chart. Okay, 4-hour, daily and weekly. And price is always drawn to these levels before making further moves. Alright, price is drawn to these levels before making further moves. Alright, so that's basically it for support and resistance from the institutional side of things. Alright, now let me talk to you guys about the mistakes that retail traders use, or the mistakes that retail traders make when they trade Forex, right? Or any market, for instance, for that matter, I mean. Right, so let's just go to the 15-minute chart, which most retail minded traders use, or retail traders use. Right, now retail traders, right, every time they see price reacting, they call it support, they call it resistance, right, they call it support. Okay, now the only reason that these points actually worked over here, and here, right? The only reason that they worked is because they were part of a higher time frame institutional support or resistance level. So if you go to the 4-hour chart, see, high time frame level, right? If I go to the 1-hour chart, a high time frame level, right? Yeah. So retail traders get really lucky with these trades, right? But when it comes to trades like this over here, for example, right, once they see it reacting, sure, price goes up, right? And they would expect price to reverse right back up over here, but it does not happen. Okay, it does not happen. For example, they put their trade here, aiming for this high, and bam, they're stopped out almost instantly. Okay, so with this point in mind, so the support and resistance, which retail traders think is support and resistance, does not work. All right, so always have a higher time frame support and resistance in mind, and always frame your trades. If you're taking trades on the 15-minute chart or below, always frame your trades based on the 1 hour, 4 hour, daily or weekly, right? Just framing your trades on the price action on the 15-minute chart is not going to help you at all, because you will lose more than you win. The game of forex is all about winning more than you lose. But if you stick to the retail concept behind all of these things, you will definitely lose more than you win. Okay, so let me just give you one trade example that a retail trader would use. Okay, alright, so yeah, let's use this as an example. Delete this, okay, because that was an institutional support. Let's go out over here. Okay, now let's say, for example, right, price goes up, fine, that's right, and we find your support, which retail traders use, over here. Okay, and this is a resistance level, right? Now most retail traders jump at the opportunity to buy at a breakout. All right, they buy at a breakout. They never wait for price to come back to retrace a bit like it did over here. They always buy at the breakout, right? Smarter retail traders wait for the retracement, but most of them don't. Okay, so now breakout traders, right, they wait for price to close above the supposed resistance over here, and they keep a buy over here on top, a buy stop over here with their stop loss right below this candle. And most retail traders just go for a risk to reward of 1.5 or even a risk to reward of 1-to-1, which is inefficient. Okay, it is very inefficient, and you will lose money doing this. But if you do it profitably, you're good to go, right? If you combine proper entry techniques and proper analysis of price action 1-to-1 across 5 to 10 trades a day, you're good to go. But trades like this, you're not. So as you can see, price hit your stop loss, and then boom, it went up. Okay, and it went up to a resistance. It's caused price to go down. Okay, now of course there are many other things in play over here, right? There are many other institutional things in play over here, because you have things like order blocks, ICT bullish breaker, ICT bearish breaker, SMT divergence, smart money reversals, right? All again, not my thing, it's ICT's thing. So please go ahead and watch his channel, because you will learn a lot and your trading will improve, right? Your trading will improve just by watching his free stuff. Okay, so yeah, I think that's about it. So the main thing that you should keep in mind is that whenever you trade, always begin your analysis from a daily, 4-hour and 1-hour perspective, right? Annotate your chart with all of the key levels that you should be looking at for price to react at. All right, and you're good to go. And then trade it at the 15-minute or 5-minute chart, or maybe even the 1 minute if you know what you're doing, right? I combine all of this with ICT's entry technique that he teaches on his free YouTube channel, and it has helped me immensely. Okay, it's helped me immensely. Now I will go across what I'm about to speak about, right? I will go about this in detail in another video, but let me just give you a sneak peek, right? So now, like I said, let's just put some random levels over here that retail traders will think is actual levels, here and here, right? Over here. Now, like I said, breakout traders, they like to keep buy stops, sell stops. Okay, buy stops and sell stops. So when they keep their buy stop over here, okay, institutions use retail buy stops to fuel their move down. okay, which means this is all liquidity for banks and other financial institutions. So all you gotta know is breakout traders and most traders, they look for several different confirmations which is actually not needed, right? And so they put out buy stops and sell stops, and that is the liquidity that financial institutions and banks use to move the market. Okay, they use those to move the market. So in a way, retail traders are feeding, or retail traders are food to institutions, right? So they use this, they use the buy stop over here, take price down to hit their stop loss, right? So when you buy something, right, right, and you want to exit the trade, you got to sell it, right? When you buy something, or when you buy a pair, when you exit the trade, you're going to sell it, and a stop loss is there to exit, right? So when it hits your stop loss, the buy becomes a sell, which is exactly what the institutions want to use to move price down. And as you can see, price did exactly that. Okay, when you see those sharp moves basically tell you, okay, I took your buy stops, I took your stop loss, thank you for the liquidity, we're taking price down. Okay, that's how you should go about looking at it, and that is how you should think like an institutional trader, think like the banks, and make money riding behind their backs or coattails, right? So that is something I'll speak about in another video. Okay, that is something to speak about in another video. So again, before I complete this video, if you want to trade profitably, if you want to have 70 plus 80 plus % win rate, always know your key support and resistance levels that the institutions will most likely use, and we get those levels from the daily, 4 hour and 1 hour, and not anything below that, right? All of these points over here, here, these are all pools of liquidity which banks use to screw you, right? They use it to screw you up, which is why most traders do not succeed in this game. Okay, trading like the banks put you in the top 1%, not the 5%, right? So just do as I've explained, right? Mark your key levels on your charts from the 4 hour, daily, and 1 hour. Go and watch ICT's free YouTube content which teaches you about the different times of the day to trade, the highly probable setups during these times of the day, the different entry techniques available to you, where you should focus on one, master that, and then move on to the next one. Or maybe you could even use that same entry technique to make money consistently, right? You can do that. Okay, so with that, I would also like to tell you that I cover these things in my mentorship, right? Given that I do talk about ICT's things in my mentorship, but I do not reteach his content. Okay, all my mentorship students are advised to watch all of ICT's videos so that they have an understanding of the entry techniques which they can use to make money with the things I teach in my mentorship, right? So with that, thank you guys for watching. Hope you like this video, right? Give it a like, subscribe to my channel, click on my notification bell, because I want to see this channel grow, and I want all of you guys to learn how it is to actually trade behind the institutions, because we cannot trade like them, we can trade behind them. We can catch on to every move that they make and make money out of that. We are not going to be trading like the normal retail traders using these retail concepts which mostly lose. Okay, which mostly lose. Yeah, so with that, I'll see you guys in the next one.